Investors pay attention when Barron's releases its top 10 stocks for the year that they claim will have serious upside. And last year, their 10 picks crushed the market. 27% returns versus 16% for the S&P. So today, we're going to look at 2026 picks through the lens of a value investor with the only thing that matters, price versus value, to see which ones might truly have serious upside. Now, before we dive into 2026 names, I want to set the frame for you. Just because a stock is on a top picks list doesn't mean it's a buy on site. And even if the list looks good, it doesn't mean it's actually going to be a great investment. And even if it's a great investment, it does not mean it's going to go up this year. 1 year is too short of a time frame. You've got to remember that no matter what we talk about here. You could pick a great company and the stock could fall, and it could make perfect sense. This happens time and time again. And for those of you who don't believe me on that one, any company right now that you can think of that you think is a great investment, just go look at its history. At some point in the past, it lost 50% or more of its value. Hell, Berkshire Hathaway lost 50% of its value 3 times since Warren Buffett and Charlie Munger have owned it. Are you telling me it wasn't a good investment after it fell 50% 3 times? Bullshit. Wall Street analysts often look at potential growth, narratives, or headline catalysts, but where they really matter is over the long run is the relationship between price and value. The price you pay, the value you receive. That's the core of how you live your personal life, as well as what we teach on YouTube and what you never hear on other YouTube channels. Understanding whether a stock is truly worth owning based on fundamentals and reasonable valuations. So in this video, we're going to take Barron's 10 stocks for 2026. We're going to talk through each one of them and determine a price we would need to buy them at using our stock analyzer tool. But before we get into those 2026 picks, let's take a quick look at last year's list, the one that Barron's put out for 2025, and let's see how those stocks performed. Now, guys, I was surprised last year. Alibaba, 81% return. Googly Moogly, 67%. ASML, Berkshire, Citigroup, Everest, Louis Vuitton, Moderna, SLB, and Uber. Look at these. Only 2 were down last year. Everest and Moderna. Guys, that's incredible. An average return of 27.9%. I own Alibaba. I was floored that it went up that much this year, and I was a big believer in Alibaba for a long time. It just goes to show we have no idea what's going to happen. In fact, I'm one of the few people who's probably upset it went up so fast. I just like steady, grow along the way. This is their new list. Amazon, Bristol Myers, Comcast, Exxon, Fairfax Financial, Flutter, Madison Square Garden, SLG, and Visa, Walt Disney. Okay, guys, so let's break down why Barron's actually chose these as their top 10 stocks for 2026 and what themes they're leaning into with this list. Barron said they took a value-oriented strategy, whatever the fuck that means, and they looked specifically for companies that underperformed in 2025 compared to the S&P 500, but that still have strong fundamentals and catalysts that could help them catch up in 2026. But instead of picking only the latest hype names, which I give them credit for, they weren't doing that have already run up a ton in price, they focus on stocks that are positioned for rebound or long-term growth at fair prices. I am very impressed that only one company here is part of the Magnificent Seven. That is impressive to me. I really expected to see a lot worse than that. Here's a quick rundown of the top 10 and their rationale behind it. Amazon, the only Magnificent Seven stock, they like it because of its dominant e-commerce share and accelerating cloud revenue growth from AWS. Bristol Myers, classic turnaround idea. It pays a high dividend and trades at a relatively low earnings multiple, suggesting the market hasn't fully priced in future growth yet. Very well could be the case. Comcast, one of the cheapest stocks in the S&P based on projected 2026 earnings, and offers a safe dividend yield of 4.8%. Cheap plus income is a compelling combination in uncertain markets for a lot of people out there. Now, the issue I have with Comcast, tons of debt, a massive amount of debt. So much debt, it hurts. Another company, ExxonMobil, they call this one the gold standard in global energy. Long-term earnings growth above 13% through 2030 makes it attractive to those who believe energy demand stays strong. But I repeat to everybody till I'm blue in the face. Demand can stay strong, but if supply is strong, prices are going to go down. Supply drives the pricing in, especially commodities world, a lot more than demand does. Fairfax Financial often describes a mini Berkshire Hathaway. This Canadian insurer is seen as a smaller, faster-growing version of Buffett's company, appealing to value investors who like insurance franchises. But remember, guys, Berkshire is very good at managing insurance. Make sure these people manage insurance the same way as Berkshire. Parent of FanDuel, Flutter Entertainment is a leader in online sports betting. Barron sees it as undervalued now because of fears around competition, but potentially positioned to benefit from a broader trend toward legalized sports wagering. To which I say to Barron's, well, everybody will benefit from legalized sports wagering. What is FanDuel's reason for being attractive? That's the same argument you can make about every DraftKings and everybody else doing it. Another one, Madison Square Garden Sports. This one is more thematic, owning iconic sports franchises at a relatively low entry price, tapping into the booming sports industry narrative. Guys, sports is awesome. Now, SL Green Realty is a more contrarian recovery play. Manhattan's largest commercial landlord. It is priced for a rebound in the New York City office market, even though the sector has been challenged. Now, guys, I love this play in terms of commercial landlord. I remember when people were leaving the offices, I was saying, you can watch this on YouTube, I was saying, I just don't think that's going to be a permanent thing. As a business owner, I didn't like the idea of having everybody in the office out of the office. There's something to the camaraderie. There's something to people talking to each other and seeing each other. And it was just a short-term blip. Now office is making a rebound. I'd have rather seen them do it back when office was literally untouchable, but I get it. It's a little scary out there. Visa. Barron's picked them as a growth lagger that should rebound as the world continues shifting from cash to digital payments, a long-term secular trend. I agree with that 100%. Again, why not MasterCard then? Why not American Express? You've got to include the fundamentals in there. Why is Visa a better buy than American Express and MasterCard and any other card-carrying company? Walt Disney. Guys, I own Walt Disney. Never own a company because somebody on the internet or even Warren Buffett has it. Chosen for its premium assets, which I agree with, including parks and streaming, but trading at a lower PE compared to peers like Netflix, Barron sees potential upside of the market gives Disney a richer valuation again. My thesis, and which I'm surprised I didn't mention here, profit margin. Look at the profit margin of Disney. Historically, before COVID, it was regularly over 10%. It just grew up to 13% recently. Before then, the last 5-year average was 5.85, and that includes that 13% here. Before COVID, it was well above 10%. Now, on top of the main list, Barron's also highlighted related categories that might be worth watching. They pointed to international bargains like Alibaba, that's great, Kering, Deutsche Bank, and Unilever, places where global value might be hiding. I think Alibaba, even being up 81%, from a long-term perspective, is still a reasonable buy today. Can you handle the volatility? That's the question. They also noted high yield or dividend growth candidates such as Qualcomm, FedEx, Chevron, and Coca-Cola, companies that throw off cash now and have potential growth. Now, finally, they mentioned tech cycle plays like Microsoft, Dell, and Nintendo, which tie back together to a broader long-term structural growth in computing and technology. The common theme from Barron's is they said they're not picking winners based on last year's performance, which I do appreciate. That's a very tough thing to do. They're looking for companies that the market hasn't fully priced yet, despite solid earnings potential, dividends, or secular growth trends. What they believe will be catch-up candidates in 2026. And of course, just because something's on a top 10 list doesn't mean it's guaranteed to outperform. That's where we come in. We're not guaranteeing anything, but we're going to analyze these through the lens of price versus value so you can decide where the real opportunities might be. And guess what, guys? If you're looking at any of these companies on a 1-year horizon, stick to low-cost ETFs. But if you want to own these companies for very long periods of time, we're the place to go to learn how to do that. So let's go analyze 3 of these 10 stocks. But first, I'm going to remind you that this is part of a bigger journey. Each month, we're working together to cross off stocks that are too expensive and focus on companies that might be undervalued and worth your hard-earned money. That is why it's so important to be subscribed and to watch all the videos we put out. This is not about one stock. This is not about one video. Over time, you're going to learn a process. You're going to see real examples, and you'll start to recognize which stocks are getting close to a price that makes sense. And the more consistent you are, the better investor you will become. Now, let's get into Disney. So right now, many analysts think Disney is setting up for a strong comeback in 2026. They're finally making real money from streaming, especially as they combine ESPN with Disney Plus and build a better product. Their theme parks and cruise lines are booming again, and that's part of the business bringing a lot of consistent profit. I don't know if you've been to Disney lately, but you buy a hamburger for about $87 per burger. Now, they keep building new rides. They keep building new attractions, more cruise ships, which means more ways to grow the experience part of their business. And they're also rewarding investors by buying back $7 billion of stock and, for those of you who care, raising the dividend by 50%. Now, if they pull this off, Disney might quietly become one of the best performing stocks of the year. And guess what? They could pull it off and still not be one of the best performing stocks of the year. But let's go analyze Disney and find the price we would be willing to pay for the stock. All right, so Disney is a $200 billion company. Last year, it generated $10 billion in free cash flow. In the last 5 years, the average was 5.3. So that's a big jump for them because, in my opinion, they were just getting back to normal levels. Profit margin last year of 13%. Now we're talking. Last 5-year average was 5.85. That included that 13%. So if you exclude last year, it was probably more like 3.5%. All right, here's their adorable dividend of $1 billion, 0.1% last year. Gross profit margin, 38%. Guys, I think everything is great. These returns on capital suck, but it's also been a sucky 5 years, so that's probably why. Let's go look at the 8 pillars here. Probably not going to be great looking. 4 X's, 4 checks. I'm not worried about the 5-year PE and 5-year price of free cash flow. It's based on much lower free cash flow than they should have had. Return on capital, not worried about it. Debt, it's freaking Disney. So not only that, their free cash, everything here I'm not even worried about. Like, this is a story. I look at this going, all of these metrics are affected by their performance since 2020. Okay, whatever. Like, it'll get better. I just don't think this is a company that's going to be making 3% a year for the rest of time. If this feels overwhelming, guess what? It's supposed to start. But you will get better at this, I absolutely assure you. It has been overwhelming for everybody in the history of the world. Nobody woke up and said, I'm a genius with investing. Never happened. This will take time. The good news for you is, this is why I'm here to teach. Everybody in this world is capable of being a good investor, and it doesn't take intelligence up here. It takes a good stomach. But if you want to learn these key metrics, I made a cheat sheet for you absolutely for free. Click the link below. I will email you these key metrics right here so you can have it at your fingertips, telling you everything about this so you can show off to all your friends and family when you sit there and start talking about returns on capital and why it matters and why you don't like a company because the returns are low and the return on equity and blah, 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 blah. Trust me, you need to go download this. Now, in a couple of minutes, I'm going to show you what price I intend to pay for Disney. But before then, let's look at analyst estimates. So it has $6.55 per share, growing to $8.32 in the next 4 years. Not that great. Not that great, actually. And revenue, going from $100 billion to $115. Now, here's what's interesting, guys. That revenue right now is record revenue. Before COVID, the most they did was like 80-some billion, I believe. Let's pull it up. 70 billion before COVID. Look at them now. Every year is record revenue. That's incredible. So as long as they can get their profit margins back to normal, this company will be spitting out cash like no other. So it takes us to the final spot. What is the price to pay for Disney? Well, guys, here are my assumptions on Disney that I have for myself. Let's take a look. I did a 10-year analysis. This is going to take my assumptions for the next 10 years, not including balance sheet, and saying, Paul, here's the price to pay based on that. 3, 5, 7% revenue growth. Okay. Profit margin and free cash flow. I did 8, 12, and 16. Not a ton, not a little, just enough where I think this 12 seems reasonable based on their history as a middle number. Next, what's the PE I'm willing to pay 10 years from now for this company? What is it supposed to be worth? Guys, always start at 15 or 16 with the market averages, go higher for good companies, lower for bad ones. Would you consider Disney a good company? Do they generate a lot of profit? Are they going to be around for a long time? What world do we have to live in where Disney does not exist 50 years from now? When I say don't exist, not being bought out, I mean like literally doors are shut. You never see Mickey Mouse ever again. You never see Cinderella ever again. They're absolutely shut down. Now, with the way the world is going in terms of shutting down all these characters and things like that from the past, maybe that happens, but I doubt that's going to happen. So I sit there and I put 19, 22, and 25 in for PE. There's somebody out there right now saying, Paul, that's too low. Very well could be the case. And there's somebody out there right now saying, Paul, that's too high. Very well could be the case. That is the art of investing. I'm not here to tell you what the right numbers are. I'm just here to show you how I think about it, and you could have very different numbers than me and be way more correct than me. So we hit the analyze button. And this is going to tell us the price to pay to get our 9% desired return. That 9% return is just to find what's the value of this company. It has nothing to do with the price I'm going to pay. I want to pay a price lower than value. I want it the price is lower, not the same. If it's the same, I might as well just buy a low-cost ETF. That's what's really important there. We're here to make good assumptions for the future in this. So, hit the analyze button. Stock's currently at 113. I have a low price of 74, high price of 240, middle price of 140. All right, that's where we stand here on Disney. Seems to be, according to my assumptions, a little undervalued. Now, our second stock, Comcast. Guys, cable providers have tons of debt. They're one of the largest media conglomerates in the world, and in a lot of ways is a direct competitor to Disney. So when you think of Comcast, don't just think cable company. This is a global media and entertainment beast. In fact, they just spun off their old cable TV stuff to focus on what really matters. They run Xfinity, which gives people internet, mobile home service, and even home security. Over in Europe, they own Sky, a massive media and telecom brand across the UK, Germany, and more. They own NBC, Telemundo, and local news and sports stations all over the country. Their cable channels, Bravo, Sci-Fi, E, Golf Channel, CNBC, they've got something for everyone. On the movie side, they run Universal Pictures and DreamWorks Animation, movies like Shrek and Minions. We cannot forget the theme parks, Universal Studios in Orlando, Hollywood, Japan, and Singapore, with more parks coming to Texas and Vegas, and they even own the Philadelphia Flyers and the Wells Fargo Center where they play. Bottom line, Comcast touches everything from the internet in your home to the shows you binge, the movies you love, and the theme parks that you visit. It is a massive, diverse empire. So Barron said they love the dividend and think Comcast is cheap. But as investors, we don't just take anyone's word for it, not even the experts. We analyze the numbers ourselves to decide what we think is a fair price to pay for Comcast that still gives us a little juice left in that squeeze. So, $100 billion market cap, $273 billion enterprise value. That difference is all debt, $170 billion. Guys, that's a lot. Yes, they did generate a lot of free cash flow last year, $18 billion versus a 5-year average of 14. Their price to free cash flow is 6. Now, the problem I have with this is they have low returns on capital and a lot of debt. This just reminds me of a little bit of Walgreens, and a company that I completely missed out on in terms of like understanding it. Look at this dividend. They can afford this dividend at 4.6%. So that's a good thing, guys. If you like a dividend yield, this is easily affordable. The question I have is, at what point, I do think you have to understand the debt on this company. And this is a good place for people in our community to have a conversation. You have to understand what covenants exist for this debt. Because if all of a sudden they can pull it off, and a bank can come and say, we want our debt paid, that could be a problem. Our community members have this company as a buy with an average intrinsic value of 44, and it's currently at 29. So I think our community members kind of agree with Barron's on this one. But look at this growth rate in terms of revenue. 3-year, 0.57, 5-year, 3.5, 10-year, 5.38. Not exactly going great. Oh, and look at this. 1-year profit margin of 18.3% versus 5 and 10-year average of 12%. So I need to find out why that is. So let's go to the income statement. Was there some big other income expense? Boop, right there. $9.35 billion. You got to strike that out. Just like back here, we struck out $9.5 billion. That's why. So they really made $13 billion last year. Don't include this other income expenses, and I assure you that nobody on the internet is doing that. That is why you're here watching us. So let's take a look at these 8 pillars. Not shocked here. Low returns on capital, a lot of debt. The question is, this 5-year PE looks pretty solid. So let's see what analysts think. 433 earnings per share growing to 514 over the next 3 years. All right, nothing great, nothing to write home about. Yeah, and then look at this revenue growth, basically the same over the next 3 or 4 years. All right, but guess what, guys? A company cannot be growing at all, but if you pay a cheap enough price, it can work. I like to think in extremes. Would you buy Comcast for $1? Not $1 per share, $1 total dollar. Of course you would. You make your money back in half a second, not even. Would you pay $1 trillion for it? No. Somewhere in between, it becomes a phenomenal investment. Where is that point? We don't know yet. So let's see if I've done Comcast in the past. So guys, here we are at Stock Analyzer. Now, you can see my revenue growth assumptions are very conservative. -2, 0, and 2. Profit margin, I actually went lower than their 10-year average. I did 10.5, 11.5, 12.5. Same with free cash flow. I went to numbers lower than this is incredible. PE, it's a low ROIC business with very low growth. I went 8, 10, and 12, and my 9% return. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're gonna get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days, you'll see. This isn't gambling, it's common sense. I have a current price of 29. This is why it's interesting, guys. Low price of basically 29, high price of 53, middle price of 40. Now, I'm gonna tell you guys my opinion. I don't like companies with much debt. I would just rather avoid it. Is this interesting? Yes. If it fit my idea of a company I wanted to own in full, I would probably be looking further in this one. But for me, the debt levels are just too big. This could be a very great opportunity for somebody out there. Stock number 3, Bristol Myers Squibb, BMY, the good old world of pharmaceuticals. This company is selling for 7.5 times free cash flow, 19 times PE. So their free cash flow, look at this, is way higher than their net income. Look at that. $15.3 billion last year, $13.6 a year for the last 5 years versus net income of $6 and $1.67. This already has my interest, but our community members have it as a hold. I mean, look at this though. Oh, look at this. Profit margin was 12.5% versus historical of 3.5%. Let's go see if they have another situation like Comcast. Well, here's another thing. When you see a big drop in the last 5 years in their net income, look at that. That's why. Last year, they had a $12.3 billion loss on other income expenses. That's going to directly affect your bottom line. They basically make $6 or $7 billion a year in net income. Let's go check out their cash flow statement. Why is this so? I mean, look at this cash flow statement. In the last 5 years, 13, 15, 12, 12.5, 14. And this is incredible. But they're not generating that net income. This is pretty interesting. Let's go look at their 8 pillars here. Low returns on capital, high PE, even though, look at this. How often do we see this? 5-year PE of 68, 5-year price of free cash flow of 8.3. This is very rare. This could be an opportunity. This is interesting. They can afford this dividend easily. 4.4% dividend pays out $5 billion of their $15 billion in free cash flow. Analyst estimates, oh boy, decrease every year. They must be losing a drug of some sort. And revenue just declining. Ugh. Eliquis and Opdivo are 2 drugs that Bristol Myers is losing very soon. They're not just another old school drug company. They're in the middle of a big shift, moving from older medicines to a fresh pipeline of innovative new treatments, which is especially important for drug companies. They are planning to launch 16 new products by 2030, aiming to make over $25 billion a year from them. We're talking drugs for heart disease, blood disorders, cancer, and even mental health. Plus, a new type of medicine using targeted radiation. Some of their big money drugs, like I said, are losing patent protection soon, which means cheaper copies will hit the market. But Bristol Myers is already preparing for that, launching new versions like an easier to use Opdivo and loading up its future pipeline. Financially, they're also planning to tighten things up, cutting costs, sticking to smart spending, and still paying a dividend that's been going on strong for over 90 years, which is currently 4.4% today. Now, I look at this and thinking to myself the entire time, why? I mean, this is a huge discrepancy between free cash flow and net income. I've got to understand this. This is the crux of the whole entire investment. How is it that different? And we see analysts just like taking a dump on this company. Let's do a 10-year analysis. Let's see what BMY does over 10 years. Might even go longer. Now, guys, I'm giving myself quite a bit of leeway on these numbers, so I don't blame you if you don't agree with me. 10-year analysis, 4%, 6%, and 8% revenue growth. Now, profit margin and free cash flow, I'm kind of doing a blend between the two, 20, 22, and 24%. But look at this. Look at their free cash flow, just getting better as the years go on. Now, what PE would I show it in 10 years? Well, there's going to be a lot of volatility here, 13, 16, and 19, especially with low returns on capital. And finally, my 9% desired return. The stock is currently 55. Hit the analyze button. I don't know what our community members see, like what they don't see. I mean, look at this. I have a low price of 70, a high price of 145, a middle price of 103. I do think you've got to take a look at this. If you understand the pharmaceutical game and you're really willing to put up with a lot of volatility up and down, because this is not a company that's going to go straight to the moon automatically. They've got a lot of things to do. They've got a lot of drugs to create. If you want to see companies that fit my process, I have picked 7 stocks that I believe will beat the Magnificent Seven over long periods of time, over 3, 5, 10 years. And I'll be honest, 2025 results were not what I expected. You're going to want to see who made the list. So click the video on your screen right now. I'll see you there. Thank you for your time.